Welcome everyone to the Jumpstart Health Investors webinar. Today, I'm super excited to have two really impressive emerging managers with me. And we're going to be talking about just the markets today. The public markets are crazily at high valuations, even though we have a global pandemic and a culture shift and all this change going on. It's hard to find good value out there, and simultaneously, the bond markets are low, and so the options for investors out there seem limited. And so, as everyone probably knows, Jumpstart really focuses only on healthcare private investing, where we think we can get an edge. And I started looking for other investors that have a kind of a unique edge or an advantage, and found Brian and Neal, who will be on here. So the idea is that in challenging markets, investors are looking for a chance to get an edge or get better return without assuming more risk. And so that's, of course, the whole game. And so I'm excited to have Neal Berger and Brian Adams here. I want to, before we dive into their funds, I want to be quick to note that this is not an offer for security. So I have an SEC disclaimer that I'm just going to read so that it's very clear. So the managers on this webinar are not offering securities, nor are they recommending the purchase of any securities or other product or service. Furthermore, nothing we discussed during this conversation is intended to provide tax, legal, or investment advice. The viewer is solely responsible for determining whether any investment strategy, or security is appropriate for them based on their personal investment objectives, financial circumstance, and risk tolerance. So with that nod to the lawyers and the SEC, welcome Brian and Neal. Excited to have you on.
Thank you. Nice to be on.
Yeah, thank you for having me.
So maybe Neal, talk through Eagle's view, and maybe just give a quick couple minutes on your background and what Eagle's view does. We circulated the video ahead of time, so people probably have a little background, but give a description in your own words.
Sure. Thank you, Vic, and thank you for all those who are attending the webinar. So Eagle's View was born out of my own family office. I've been in the Wall Street industry for over 30 years. First half of my career, I was a proprietary global macro trader. Most notably, I've been in the hedge fund industry for over 25 years. I joined what was a little known hedge fund back in 1995 called Millennium Partners. I was one of the first, let's say, dozen employees of Millennium, worked there on two separate occasions throughout the 1990s. And the founder of Millennium, who's a pretty famous guy. Millennium is now running $44 billion, and
yeah, they're one of the most famous platforms doing this now, I'd say.
Yeah, they're within the top 5 or 10 most successful hedge funds in the world. So I was very lucky and fortunate to have the founder as my mentor, and I worked at Millennium on two separate occasions during the 1990s. And a lot of what I do at Eagle's View is informed by my experiences and what I learned, by my mentor at Millennium. And so in the late 1990s, again, through relationships that I got, I was able to garner relationships that would allow me to garner large allocations of initial public offerings, new issues in the technology space during the internet craze of the late 90s, and then flip those out and make a fair amount of money. So unfortunately, the NASDAQ burst in 2000. I didn't lose any money because I was just, flipping them out on a short-term basis. So I made enough money, but the game was over. So I made enough money to start my own family office, backing traders that were more. I retired from the global macro trading business, which is a challenging way to make money, and I started backing, more market neutral, more niche-oriented strategies, and I started investing in external hedge funds in that regard. And then I had a bunch of high net worth individuals and families and some select institutions who wanted to invest alongside of me. And therefore, I founded Eagle's View Capital Management in 2005. So I wouldn't quite say we're an emerging manager. We've celebrated our 15-year anniversary this year. We're kind of unknown and we're under the radar. I'm told, we have a number of products. We started as an advisory business, and I'll get into it more. But we have 6 fund of funds products, and I'm told we're the #1 performing fund of funds in the world, although that's not necessarily our objective, which I can get into later on in the call, but I'll pass the baton to
and so
Brian.
just to summarize, what I really love about your story is you were doing this for your own account at first, and really looking for non-directional, meaning like the market goes up, market goes down, is immaterial. You make money in any scenario. You did that for yourself, and then I assume some friends, associates, other people started sort of following along, and then it got incorporated into Eagles View.
Exactly. People knew me from my trading days, from my experience at Millennium, from other shops that I had worked at, and they wanted to, they knew I was a trader of every product, and I knew, I was a Wall Street insider, and they wanted to invest. And again, I know we'll get into it further along, but Eagles View's core business, first and foremost, is to preserve capital during any type of market environment. So first and foremost, we're in the wealth preservation business, which is why we were able to make decent money in March, April, May, and June. And the second priority is to produce returns that are completely non-correlated from equities or any other direction of any market. Because we think if investors want that, you can get that a lot cheaper elsewhere through passive index products. Nobody needs to hire me to duplicate what they can get from equities. And that's for better or for worse, by the way. If equities are, going up, last year, I think the S&P was up 31% and our flagship product was up 7.5%, but we have nothing to do with the direct, but conversely, the market was down huge in March, and we were up 2 or 3% depending upon the product. So our second mandate is to produce non-correlated returns in a world that's starved for something that is not beta related or tied to the fortunes of the market. And then the third priority is to produce the highest risk-adjusted returns only in the context of the first 2 priorities. So, I think I've used my allotted time, but I'm happy to elaborate further on that.
In this world where I feel like everything is beginning to be so correlated together, it's really impressive to see you like pull off other things that are not. So Brian, talk about Excelsior, and you have a very different thesis. Talk about that.
Sure. Thanks, Vic, and appreciate you having me. So full disclosure, I'm a New York guy that married a Nashville girl. My wife's family has worked with Vic for a very long time, and we continue to work with them, and big fans of what's going on with Jumpstart. Myself, I'm a recovering attorney, started a real estate company 10 years ago. I discovered that high net worth individuals and family offices and independent RIAs all wanted direct deal flow in the commercial real estate space, but had a lot of trouble accessing institutional style deals and asset management in what I call the middle market space. And so created a firm, started doing a lot of co-investing. We raised quite a bit of capital and deployed it across the Southeast and Midwest. I grew really fast, probably too fast, made a whole bunch of mistakes, and have a new iteration of my company that I started 2 years ago, where we're very focused on investor relations, transparency, and we do really 3 things. One, we provide access institutional kind of caliber opportunities to individuals and families. We produce a 6 to 10% cash on cash yield, and we do a lot on the tax side to enhance all the benefits that folks get from having direct real estate ownership through their K-1. And so those are the 3 things that we do. We raise capital on a deal-by-deal basis, typically secondary markets in the Southeast and Midwest. And so we do have an investment thesis around millennial migration patterns. Kind of won't get into it now, but happy to jump into it if there's specific questions.
Yeah, that's great. So I think it's a really interesting hybrid, right, where and to disclosure, I'm an investor in some of Brian's positions. It gives you access to the caliber or the quality of due diligence and deal size and professionalism that you would think of an institutional investor, but in the forum and frame for an individual. And individuals care about taxes where maybe an endowment fund may not be as concerned about taxes.
What I found
it's
was
a really interesting product. It's not that
yeah, I
common.
mean, I finally actually started listening to my investors and hearing exactly what they wanted. And the pain point they had was oftentimes to get good quality commercial real estate, their options, even if they were ultra high net worth, were to do a Blackstone or a Carlyle fund of funds or do a one-off deal with somebody they knew from the golf course. And so there was just this need in the middle market to provide access to good deal flow, but on a direct co-investment basis. I think the fund model was problematic and is problematic for a lot of people. And so it lets us be flexible and nimble. And, we typically do 4 acquisitions a year. Obviously with COVID, it might be a little bit different this year, but we did close an acquisition in June. So.
Yeah. Okay, good. And then the fund that I run is called Jumpstart Health Investors. We are focused on health innovation and bringing innovation to market. Normally you'd call that venture capital or growth investing, but we have sort of approached it from a unique point of view where we have a demand-driven investment thesis. So the market participants, hospitals, insurance companies, large retailers, they ask us to bring them solutions, and we invest in those companies as we bring them out. And so you end up with pretty good risk profile that we're in the 60-70% of our companies are successful, but in the high growth private space. And so that's Jumpstart. It's a healthcare focused private equity investment thesis. I've been doing healthcare investing for 20 years or so. As with Brian, a Yankee that moved to the South. And so maybe Brian, jump in on in the promotion for this. I was talking about getting an edge or an unfair advantage. Real estate, of course, is lots of people in real estate. How do you get sort of an unfair advantage in this space? How do you get the best deals?
Yeah, so there's an adage in real estate that the amount of brain damage it takes to do a $100 million deal is the same as a $10 million deal. And that's, for the most part, very true. It is a very capital intensive business. It's getting these deals over the finish line from a diligence perspective, coordinating with the lender, getting legal all lined up and ducks in a row to get the deal closed is a lot of heartburn, frankly. But the difference is that if you focus on that $10 to $20 million price range, there is a dramatic price differential from, that north of 35 million, you're going to get a lot of private equity in just a more efficient market. And
yeah,
so
there's a lot more buyers. There's a lot of people bidding on it.
Yeah, the buyer pool is very deep. And frankly, considering all the sovereign wealth funds moving into US real estate, even the fairly large private equity groups have gone down market, both pricing and deal size. And so if you have a nice little niche, you can build a good brand and reputation amongst the brokerage community and start getting off-market looks where our pitch is typically, if this is a beauty contest type sale process, we're not the best buyer. But if you want a professional experience, no retrades, closing in a timely fashion, and kind of doing business like gentlemen, if you give us a little bit of price, we're going to behave accordingly. And so we're typically in that 50 to 100 basis point cap rate discount, just because of our reputation and brand in the marketplace. So that's kind of how we do it. I would have said we do a ton of time on the road, meeting with brokers, et cetera. But obviously with COVID, our travel has been a little bit curtailed. I will say another interesting dynamic that I'm not sure a lot of people are aware of. Some of these larger brokerage firms like Cushman, CBRE, Colliers, they become true institutional firms. They're publicly traded. They have Wall Street analysts, looking at their monthly and quarterly financials. They're very revenue driven. And what they've done is they've really, because if the deal is under 25 million, it's just not going to get the looks from the larger capital markets groups at some of these brokerage firms. There's just not enough fee juice to go around. And so oftentimes what we do is we'll go to a leasing broker on a smaller deal who has a relationship with the owner, and we'll say, hey, if you give me a look off market, we'll retain you to do the leasing, we'll retain you to do the property management. And that's usually how we get off market looks.
Yeah, it's pretty interesting, almost middle road. Like it's a bigger deal. You're doing bigger deals than two, like me and one other golf buddy could do from a size point of view, but a smaller deal than the big shops would do.
Yeah, I mean, it's that kind of Goldilocks investment thesis that,
right.
You know, through trial and error, we found a good price point we like. It's typically in that, I'd say 15 million is kind of our magic number where, you know, even at decent leverage points, it's still quite a bit of equity to raise. And a lot of individuals or syndications just don't have the ability to put together $5 million of equity. And then you get into the lender issue of, you know, they want a credit-worthy guarantor, even if it's non-recourse. And so a lot of individuals and families just don't have the capacity.
Right.
So we've carved out a nice little niche for ourselves.
Yeah. So Neal, same question regarding Eagle's View. So talk to me about, I know you think a lot about sort of how you can get a proprietary advantage or an edge in the landscape.
Sure. So a couple things I want to mention. First of all, where Eagle's View fits in, as I think you were alluding to, Vic, the 60-40 model is dead. I mean, there is no 40 anymore.
Right. Right.
So Eagle's View tries to fill that void of, you know, what used to be, you know.
I mean, I would say it's a replacement for bonds. Like I can't get any income on my bonds anymore. So.
Exactly, and you know, we just got approved by a multi-billion-dollar, a $15 billion private bank, and that's actually the way they sold it to their advisors, by saying, look, you know, there's no yield in bonds, and Eagles View, to be clear, doesn't have a yield. We don't pay out, you know, but the return stream that we generate is, you know, smooth and steady, you know, more like, you know, shooting for 10, 11%. I mean, we're up, you know, anywhere from 7 to 10% year to date.
If I'm doing a Sharpe ratio or something, or trying to assess my portfolio, adding you in has a similar
I mean, we're meant to be a diversifier away from beta play. So I wanted to set the framework of who we are and who we're not. And so what are we looking to do? I would say first and foremost, I don't spend 10 minutes a year thinking about whether the market is going up or down, whether the Fed is going to lower interest rates, raise interest rates, what's going to go on with fiscal policy. Over the 30 years that I've been in the industry, I've never met one single person that could predict that with regularity and then translate that into market performance. And thank God, because had I known, had a genie come to me 3 or 4 months ago and told me exactly what was going to happen with all the events that are going on in the world, I probably would have lost a fortune of money, you know, because I never would have expected market movements to be this way. So we're not in the game of predicting the world or trying to, you know, figure out which way things are going. We're in the observation business. So at the core, what we do is we're observing the world or the market mechanics. I call it the market microstructure, and we're looking for structural inefficiencies in the market based upon how the world is changing. You know, the advent of alternative data, the advent of high frequency trading, the you know, increased activity of day traders and Robinhood and passive indexation. I mean, these are all observations. These aren't predictions. And then from that, we think about, okay, based upon the market dynamics, what's going on, what inefficiencies are being created in the market, and conversely, that we can take advantage of, and conversely, what inefficiencies are being degraded that have lost its positive expectancy or lost their edge, so to speak, to use your term, that we need to exit from. And so another point I would make is that, and it's a little bit along the lines of what Brian was alluding to, is that our firm manages about $300 million currently, and we have about $500 million more in capacity. So by hedge fund standards, that's relatively small, and that's by design. We don't have any marketing effort. We don't have a marketer. We don't have an investor relations person. Our clientele has all come through us through word of mouth. I mean, you came to me through a mutual colleague. So, by being, by being able to be, so when I started in the industry 25 years ago, there was collectively $50 billion invested in hedge funds. Today, there's north of $3 trillion. And that money comes from the largest investors in the world, the sovereign wealth funds, the pension funds, the university endowments, the foundations. And because of their size, they need to deploy, it doesn't make sense for them not to deploy $100 million, $200 million chunks of money even as an initial allocation. And so that puts them at a severe disadvantage. The disadvantage is that they're relegated to invest with only certain strategies and certain managers that can accommodate that kind of size of capacity. If you're investing $200 million, like a sovereign wealth fund or a university endowment, you have to be investing with a manager that has multiple billions of dollars, $2, $3, $4, $5 billion. And that manager can't transact in some of the strategies that we transact in, and if you want, I'll get into it, but congestion trading across the electricity grid, or high frequency statistical arbitrage, or inefficiencies in shipping derivatives, or all these niche strategies or even cryptocurrency arbitrage, they're all capacity constrained strategies. So by fishing in a pond where there's 5,000 fish and only 5 guys like myself can fish there, is a lot more fertile for a demand supply equation for edge than trying to fish in the same pond that everybody else is trying to fish in, where there's only where there's 5,000 people trying to catch 5 fish, so to speak.
Yeah, I mean,
so
it's
much
almost
like Brian trying to stay small and niche and nimble.
Yeah, so like at 300 million, you can participate in these niche markets, and it can be a meaningful position for Eagles View or funds managed by Eagles View.
Sure, a 10 or $20 million allocation to us is meaningful, right, whereas that wouldn't even be a rounding error for the majority of the largest investors in hedge funds, and that's sort of our edge.
You're observing things that others don't see. It's that you've designed your structure to take advantage of them in a way that is really what you want to do and what your clients want you to do, and delivers this bond-like return profile. But it is it's very predictable. It's not a secret, but it's hard to access and hard to do, and the people that can do it are limited, and many of them have huge funds that they can't really access. It's too much.
I agree, and I'll take it a step further to say that I believe the hedge fund industry, by and large, is simply a diluted proxy for the equity market. I mean, it's no coincidence that March, just to use
it's a diluted proxy with huge fees.
Yeah, exactly. And so why does anybody need that, right? So, I would argue that it has negative expectancy or negative alpha, to use, right, to use the term broadly. As an industry wide, I'm negative on hedge funds. I mean, with $3 trillion, it's just too crowded. It's too saturated. There's too many people, too many geniuses, and forget about the people. It's now robots trading. So there's too many genius robots and people trying to capture, an inefficiency in crowded markets. So if it weren't for what I'm doing, I wouldn't be interested in hedge funds, because they're just too much money chasing too little, opportunity set.
Yeah. So explain, because it's super complicated. Is it possible to explain one example, like maybe electricity grid congestion? What side of the trade is your manager taking, or how? Just help me conceive of that. Not all the secrets, but just in general, how does it work?
Sure. So maybe I should briefly start off by saying, what are we looking for when we look at an investment, whether it be electricity or arbitrage? I'll get into your specific answer, and I'll try to be as quick as possible. So we're in the search for positive expectancy. Okay, that's where we're in the business. Positive expectancy means, a greater than 50% chance likelihood of winning. Like a casino owner has positive expectancy, a gambler has negative expectancy. It doesn't mean
if I'm dealing blackjack, I won't.
You're going to win over time.
I'm going to win over time.
Right. Over a statistically relevant sample size of time, you're guaranteed to win in the game. Okay. Now that casino has different issues with expenses and bringing people in the door. Right. So positive expectancy means you're guaranteed to win over a statistically relevant sample. And that's our quest. And so in order to do that, we need to find a strategy or a manager that has a true edge. So what we're focusing on is what is the edge of the strategy? We're an absolute return fund. Okay. We're not riding beta. So if somebody's making money, that means somebody else is losing money. It's a zero-sum game. So what is your edge? who's providing that edge? Who's providing the juice for you to make the money? Why are they providing that edge or that inefficiency? How long do we expect that edge to persist? Which, by the way, even if we expect it to play for 6 months, we'll do it for 6 months. But the important corollary to that is, what is it going to look like to us when that edge dissipates? Are we going to have to lose 20% to realize there's no more edge?
Like, what's the signal? How do you know that it's gone?
You know, the observation of the markets, you know, obviously so we exited quant. We started exiting the majority of quant in 2016 because we saw the space, you know, as the, you know, the less sophisticated money started to become a little more sophisticated and move towards passive indexation and Vanguard and ETFs. You had a bunch of, you know, robots playing against robots. That's not a fertile playing field for me. So it's observing the world again. And also you can tell by a degradation of the returns. And, you know, a perfect example is my IPO flipping days. You know, when the NASDAQ crashed, there were no more IPOs. But it's exactly what we're looking for, that asymmetry where we don't want to lose a lot of money when the edge dissipates. It's heads I win when there's opportunities to flip IPOs. And then if there's no opportunities, well, I just don't make any money and I take my chips off the table and I find other opportunities. And then the final thing I'll say is the person we're investing with, or the group we're investing with, do they have the background, the pedigree, the track record, the knowledge, the experience to capitalize on the inefficiencies they're seeking to capitalize on? So with that framework, I'll answer your question about the electricity space, because it's an instructive one, and everybody can kind of understand electricity because we all turn on the lights and the air conditioning and the heat. So it's a space that's dominated. So when you say which side of the trade they're on, they're not on any side of the trade. They're not making directional bets. They're capitalizing on inefficiency when there's congestion across the grid. So congestion develops because of changing weather patterns. Like I'm here in New York, there's a tropical storm being forecast that's going to change the load factor, or, you know, there's a transmission outage because a plant and equipment is 50 years old. So, you know, there's over 3,100 utility companies in the United States that are all private organizations that are buying and selling power 24 hours a day, 7 days a week, 365 days a year. But importantly, they're playing for supply management. Nobody's getting fired for paying $1 a megawatt hour more than the next guy at a utility company, and nobody's getting an extra bonus for paying $1 a megawatt hour less. They're getting fired if there's a heat wave or a snowstorm and there's a surge in electricity usage and there's a brownout or a blackout. That's their mandate. And so, you know, with 3,100 plus nonprofit motivated participants and a high barrier to entry to really understand this space. I mean, there's only a few dozen people in the world that understand how to trade congestion across the electricity grid. It's not like you can just sign up and you know.
So let me just play that. So a utility may be willing to lose money consistently, like every quarter lose money, in order to guarantee supply. Because their customers,
they're not trying to lose money, but they're not
that's
sensitive.
Not their goal. Their goal is to guarantee supply.
Right, because the cost of the electricity is a pass-through cost. It's a couple of pennies on your electricity bill. We all have an electricity bill. But what I'm referring to specifically, if let's say there's an outage, there's a transmission outage in Western Pennsylvania, you know, and there's another, you know, and there's a power company that services Western Pennsylvania. There's a separate power company that services Eastern Pennsylvania, just to give you an example. So the constituents in Western Pennsylvania still need to be able to turn on their lights. So when there's a transmission outage, my guys understand how power is going to flow and what moves are going to be made so that the constituents in Western Pennsylvania, in my example, are still going to get their power needs met. So we'll take advantage of that quickly because we are profit motivated, whereas the utility companies are a little slower. They don't really care if they're overpaying. They're just trying to do everything they can to get power to the constituents where there's a power outage or there's a surge in electricity demand, you know, it's called load, you know, where there's an unforeseen snow, you know, heat wave or snowstorm, that sort of thing. So it's the demand supply equation between the edge providers, the nonprofit motivated participants being enormous, you know, over 3,100 of them, versus the profit motivated participants that really understand how to capitalize on the inefficiencies that are being created, which is only numbers a few dozen. And very fertile demand supply equation without making any directional bets. And so we understand who's the edge provider and why they're providing the edge, because they're really, again, the cost of the electricity.
That makes it reasonably sustainable, right? They have different motivations, and so they're happy to have this market function, and your group and a couple others are sort of facilitating that and helping it.
Right, we're providing liquidity, and that's only one example of 15 or 20 other kind of strategies. But I'll say one other thing. In the power space, there's even a tremendous diversification, because what's going on in California, for example, California power, which is often very influenced by solar and the sun, is entirely different than what's going on in the Northeast United States, which is entirely different than the Southwest Power Pool, which is Tornado Alley, and that's heavily affected by tornadoes. So even within this broad strategy that we're talking about, capitalizing on inefficiencies across the electricity grid, there's a lot of diversification, because we might have a manager that's making a ton of money in Texas, which power, or California power, but nothing is going on in the Northeast. So there's it's really not, you can get a lot of diversification even within this one broad strategy category.
Excellent. Okay, and then Brian, let's get back to you. So talk to me about real estate. So with COVID, all three of us are working at home, right? And there's going to be shifting patterns in how people work. How do you think about that as an overlay to you doing commercial real estate investing? I mean, you're in different markets, but how do you think about that being positioned?
Yeah, and I'll address this question for Mark. It's a great question.
Yeah.
So for perspective, we manage about 2.5 million square feet. Portfolio is probably 350 million gross asset size. We're in 12 markets. To date, we've had 93% rent collection, March, April, May, June. July looks to be close to that, although a lot of these tenants don't pay July 1, right? So it takes 2 weeks sometimes to really understand where things are. Pre-COVID, 4% of the workforce worked remotely. And I want to draw a distinction between working remotely and working from home, because they are two very different things. And I think oftentimes they get conflated together. We're all suffering from, and I'm completely biased, right? So this is what it is, but we're all suffering from recency bias, where we think what we've been doing the last 3 or 4 months is going to be what we're doing for the next 3 or 4 years. And that just isn't the case for anything, frankly. Office is an interesting asset class because typically people are signing 5, 7, or even 10-year lease term deals. And if they are credit tenants, those are contractual obligations. Those are liabilities that they're responsible for. So knowing the true impact of what COVID will have in office, it is just too early to say. So any prognostications you see, I would take them at a discount, frankly, because it will take a decade for this to really shake out. Now, that being said, I think office has proved to be a very resilient asset class. If you look at 9/11 and 08, and even back in the 70s when GE and Bell and some other pretty big corporate users tried pushing this remote working theory, and it just hasn't proved to be effective. Ultimately, onboarding new employees and maintaining a culture requires shared experiences. And it's very hard to get those shared experiences over Zoom or a phone. We are human, we are social animals, we want to be together. Now, I completely concede that the way that we use office will change in the next, call it 5+ years. This trend line that we saw over the last decade of moving towards incredibly dense office use, very expensive build outs like the WeWork model, where some locations had 75 square feet per employee, I think that's obviously going to move the other direction. So you'll see a shift back towards more traditional office layouts, which is more like 250 square feet per employee, more traditional offices with a door and walls. So I think the days of hoteling and benching and hot desking are going to go away. What will be interesting is as people and employers, and this happened after 08, I think a lot of employers and corporate users are realizing that they don't need as much space as they probably have today. And they certainly don't want to spend as much money on space as they have today. And so our personal investment thesis is that you will see a shift towards a hub and spoke model where the mothership might still be in New York or San Francisco or Chicago, but they'll start relocating a lot of the secondary internal services to, markets more like what we have here in Nashville, Austin, Denver, and then, to a lesser extent, some other places that we have an eye on. I think what you're seeing is Wall Street had a narrative that millennials, which are now the largest working population group in America, it's roughly 75 million people, that they were going to forever live in tower apartments in Brooklyn and eat avocado toast and never have children. Because of 2008, their family formation period got pushed back 5+ years to what was average in America. And now that they are having children, and they've kind of gone back on their feet from 2008, they were starting to make decisions about where they wanted to live, work, and play based on cost of living, quality of life, access to affordable single-family homes, and access to education for their children. I think COVID will accelerate that demographic shift, and you'll see a lot of this maturing millennial group decide to relocate to the suburbs. And I think what we've seen over the last 100 years in America is that every generation rebels against their parents on some level, but ultimately we end up living a very similar life to what our parents did. And so
you rebel until you have I think it's the second child.
Yeah.
Then you realize, gosh, I kind of do want a backyard and I want some more space.
Yeah, I mean, I think what you'll see, and it's not a zero-sum game, right? I think that's another mistake people make when they talk about office or demographic shifts. I mean, these people leaving places like New York will mean that New York will be more affordable and younger people will go there to cut their teeth and find their, special someone in their life. That will continue to occur. This is just a natural cycle that we've seen play out. So we think suburban office is really well positioned. But again, really too hard to see. I just can't envision a world where people are actually working from home. When you read those surveys, 80% plus want to work from home. Well, they did for the next 30, 60 days. I think what you see is a pretty big lag in productivity after the novelty. And frankly, people are worried about losing their job. When that wears off, I think we're all going to want a more distinct line between work and life, because everything that I've read and seen, people are on average working a lot more than they were when they had a traditional office setup. Weekends are kind of, there's a blurred line there, right? And so I think...
Yeah, I've been saying a lot that I love the fact that I don't have a commute to and from work anymore. That saves me, and I have a short commute, saves me, an hour a day in the car, 30 minutes each way. But I hate the fact that I now have to sleep in my office. Like, my office is in my home, and so I'm never far away from the office.
My mother-in-law nailed it. We were having a drink last night, and she said, "It's not work from home; it's live at work."
Right.
And I think it's really true. And we're all, I'm suffering from burnout. Just a change of scenery would be nice, and just interacting with other people and having that kind of spontaneous conversation with a coworker where creativity happens. I think we all miss that.
Yeah. Okay, so I want to jump back into more of a interesting question that I'm personally interested in. I think the audience might be interested in, which is, as you interact with investors and you do due diligence on your firms, what's like the best due diligence question that investors really should ask as they're considering investing in any fund, honestly, but they fail to? What are they missing? What have you heard that you're like, that's a great question, and maybe you're starting to ask, or investors should put it in?
Who do you want to?
So maybe Neal, go ahead.
Sure. So the most common question that an investor asks, from the most sophisticated investors in the world down to the least sophisticated, is, what are the returns? That's the number one question that everybody asks. And in isolation, the answer to that means nothing. I once gave a speech and I said to the audience, I'd like to take a poll. I have two managers and one made 10% and one made 15%. Who's better? And, I said, who thinks the manager that made 15% is better? And then, few people sheepishly raised their hands. They kind of knew it was a trick question.
They knew it was a trick,
and then,
right.
Yeah, and then I said, well, who thinks the manager that made 10% is better? And nobody raised their hand, and probably got a quarter of the audience raising their hand anyway. And I said, the answer is, now let me tell you that the manager that made 15% went long Turkish bonds with 3 times leverage and happened to get it right. And the manager that makes 10% has never had a losing day, and he does ETF redemption creation or matchbook securities lending. Now tell me who's better. So the question is not what are the returns. The question is, what are the risk-adjusted returns? Or, when someone gives you a return, how much risk did you take to achieve those returns? Because, when an investor is considering an investment, past performance is interesting and everybody looks at it, but really you're concerned about the performance after you invest. And if someone, maybe hit a home run, does that mean they can also strike out, because they're taking huge risks? So I think the question that investors fail to ask, which is the single most important, and it's not just a simple question, it speaks to liquidity, the changing liquidity, how can liquidity change in this market? How can risk change? What could happen? You saw in March, even treasuries got illiquid for a time being, really dig into the risk side of it, and how are you managing that risk? In our case, where I spoke about electricity trading, but as I mentioned, it's one of 15, 20 different strategies. It obviously has no correlation to inefficiencies in shipping derivatives or new issues flipping or high frequency statistical arbitrage. So we're trying to put together an orthogonal or a highly diversified portfolio of positive expectancy investments, because none of them are riskless, right? There's idiosyncratic risk in any individual strategy. But just again, use my casino analogy, somebody can come along and pull the slot machine and win $1 million on the jackpot, but the casino owner doesn't worry about that, because at the same time, somebody's losing $1 million on the craps table or losing $1 million on the blackjack table. So, just to sum it up, focusing on not the returns, because asking that question in isolation, what are the returns, doesn't really mean much unless you understand the other side of the coin, is what risks were you taking and are you taking to achieve those kind of returns, and what can go wrong.
Yeah. I think
that question is not asked by the most sophisticated investors in the world. It's amazing. Or not really understood.
Right. So people on this call can now do due diligence like a sophisticated investor, or better than.
Well, that's one question. Yeah, there's many things to ask. I mean, on the operational due diligence side, how is the money moved? I mean, when you look at the frauds that have been, it's not because the manager doesn't have, gets hit by a bus. I mean, the standard question is, what if you get hit by a bus? I've never met an investor that lost money because his manager got hit by a bus. I have met investors that have lost money because the cash movement procedures are lax, meaning one guy can literally wire money out of the fund. And, let's face it, you get a bunch of 30 and 40-year-olds with $1 billion bank account, and maybe they run into some personal demons or personal issues. It's seductive to for some people in the past to have done that. And so, on the due diligence side is, how is the cash moved? The industry best practices are, if the cash is moved by an external third party, a credible third party administrator. The auditors don't move money, and obviously you want to have credible auditors. We use KPMG, for example, but you want to have credible third-party administrators, whether it's Citgo or State Street or Goldman Sachs, that they're the ones that can only move the money with the initiation by the manager. And some of that's, there's many things to ask, which is why people hire us, because there's a litany, for every manager we invest in, we have over 1,000 pages of due diligence that we do on those investments, which is just impossible for someone who doesn't even know the right questions to ask. But that, giving you a little bit on the investment side, but then the operational side is also equally important as well.
Right. Okay. Brian, what have you seen out there? Or what have you heard that the people should copy?
Yeah, I think one of the biggest mistakes I made early in my career was just having a very straightforward, honest conversation about expectations on both sides of the table. And really being very clear, as my wife would say, clear is kind, like Brene Brown says. So, my take on it is, the three things that I ticked off earlier, capital preservation, cash flow, and tax benefits. Those are the three things that we're going to do. But what I found is the investment and the returns and the economics are almost secondary to the experience the investor has. And so I talk a lot about, this is what you can expect from us: monthly financials, quarterly updates, access to a portal, access to me during the day, any and all questions. But oftentimes I had investors who, they were very IRR driven, or the minute that we bought something, they wanted to sell it. And that's just not our style. It's not our investment thesis. And I've tried to do a better job of just being more transparent. And a lot of investors might not be a good fit for me. I have a strict no jerk policy. I found, which, I think it's important to just put it out there. And we don't work with institutional LPs. So that's just not how I want to do business. It's not the people I want to do business with. So I think the biggest thing that people don't ask when they're doing an investment in private equity or an alternative is just what the expectations are moving forward. Everything from reporting to returns to what our relationship is. I've tried to just be much better about having that open conversation on the front end, because I think it solves a lot of problems down the road.
Yeah. Yeah, interesting. So the one that I use a lot is, tell me about how the incentives are aligned with you, but more importantly with your employees. So like, as you have people in the organization, how are they reviewed? How do they get promoted? How do they get bonused? How do they get paid? Because you can hire really ethical, great people, but if you pay them to do other things, then they're at least at odds with things. And so I always want to learn about how the incentive structures are mapped out.
I mean, I've found that obviously everyone wants to make money, but the sophisticated investors realize they're taking a risk. Not only a risk and I think one of the issues is, kind of to your point, Vic, I'm not sure investors, even pretty sophisticated ones, understand that there's the risk they're taking on the investment, like the deals that I do, but they're also taking a small business risk with me because I'm running a small business, right? I've got 12 employees. There's all kinds of things that I do that are not related to the actual real estate itself. And I'm not sure there's an appreciation for what that small business risk looks like. And just how much
work. If one of your employees left because they take a job somewhere else, can you replace them easily? Can you not replace them? Like that is.
And the reason we've shifted away from being a fund manager is running a fund is a lot of work, just in and of itself from a regulatory and compliance standpoint.
Ask Neal himself how it.
Yeah, I was detracting from our performance, and frankly, our LPs didn't really care if it was a fund or direct. So that's just an example.
Right. Good. Well, so Neal, maybe
one thing you kind of mentioned before, because it came up, and I know it's important for some of the viewers. We're a bit unique. We have a lot of these trading-oriented strategies, but our and I would say our goal is roughly 10% net per year to the investor, but we've modeled out to 8%, roughly speaking, long-term capital gains treatment on our return stream. And that's because we deploy a strategy that throws off as a byproduct of its activity. I don't know how sophisticated people want me to get, but futures contracts are 1256, so 60% long-term, 40% short-term. So we have a strategy that actually throws off quite a bit of short-term loss that offsets our short-term gain and leaves us with long-term gain. And so
so you have intentionally designed that,
right? Because we're sensitive
to the tax structure, right?
Right, in our U.S. taxable products. I mean, we're very sensitive to, it's not what you make, it's what you keep, and we obviously want to pay Uncle Sam as little as possible, and we want the investors to get as much as possible.
Yeah. So just in the little bit of time we have left, I've been sitting here kind of thinking through. I mean, we have three very different funds, right? Like or strategies. I'm investing in healthcare, private innovation, new growth things. You're at absolute return. Brian's real estate. But I think that we all, as a sort of people that are looking for kind of a repeatable systematic advantage. I'm struck that we've all chosen sort of a size differential, and we have an information advantage and maybe an access advantage that other people don't have. And I just want you all to comment on, does that make sense? And is that, are those the three components, or are there other ones that are important?
Well, yeah, I certainly agree with what you said. I mean, as I spoke about before, I mean, I'm not trying to compete with Blackstone, nor could I compete with Blackstone. Right. I mean,
well, it's just a different game. Like they are huge.
Yeah.
Different.
And investing in Bridgewater or Oxif or Brevin Howard, I mean, our LPs tend to be super sophisticated. The majority of our money comes from other hedge fund managers themselves or other industry professionals. We get some money from some wealth advisors, independent RIAs, as Brian said. But the majority of our money actually comes from other hedge fund managers that know us, that want to diversify some of their money away from their own fund. But and that actually gives us a huge edge because they're not in competition with us. So being a native New Yorker, and probably you can tell by the way I talk or my mannerisms, I still got that New York in me, loud voice, talking with my hands. But I've been in the business over 30 years, so we know the people that are in the news, and we're friendly with them, and we've done well with them. We've helped them with favors, and conversely, we can go to them and say, hey, who do you we're not in competition with each other. Who do you think is great, through your travels? And we do. We ask our investor base. We sometimes help our investor base evaluate some opportunities and some funds, because number one, we want to add value to our investor base, but number two, it's a sourcing channel for us. We may find an undiscovered manager that we weren't aware of that we find attractive. So yeah, it's the sourcing.
Yeah, it's a combination of like insight that other people don't have, and then access to trade on it or move on it. So like I have better information about the healthcare space than others, and then I can jump in and capture it. And you are in the fund manager world. And I think, Brian, I want you to comment on those three attributes.
Right.
But
I'll just say one last thing is, for me personally, I think the fact that I was a former trader and traded every product helps a great deal. There are not many hedge fund allocators out there today that were actually frontline traders, especially at the levels that I was at. And it
allows you to interact with and do due diligence on the actual traders underneath you.
Because I was sitting in their seat, the first half of my career.
Yeah. Brian, what are your thoughts?
Yeah, so I think this democratization of access to alternatives for individuals and families is an incredibly powerful force. And what you've seen in the institutional private equity world is, I think the latest statistic I saw was 80% of all institutional LP dollars allocated to commercial real estate went to 5 managers. So kind of the Blackstones, the KKRs, the Carlyles of the world. And, what those firms are these days, whether they're publicly traded or not, they're really valued on an AUM fee basis, right? So what you have are just these huge amounts of large institutional LPs. And then what they do is they'll create feeder funds or fund of funds, or have an agreement with BAML or somebody to try to suck up some of the retail dollars. And I think one of the things you need to realize is, as a taxable investor, you should be looking at net of fees and taxes returns, and not some big, hairy gross IRR, because it's meaningless to you as a taxable investor. And so one of the things that we've done is, consciously gone down market in terms of deal size, and we think we can still generate some alpha there. But again, it takes discipline, because what I've discovered earlier in my career is just because you can raise a lot of money for a deal doesn't mean it automatically is a good deal. Right. So I think just having a little bit more discipline and sticking to your knitting as a manager, suffering from style drift is a real thing. And I'm not sure investors can appreciate that. Oftentimes in our world, especially real estate, bigger is considered better. And once managers can go raise more capital, they will, and not always to the betterment of returns.
Yeah. I mean, there's operating leverage in the management company, but it is a detriment to returns.
Yeah.
Okay.
That's been my experience.
Okay. Well, thanks, guys. Neal, Brian, any closing parting shots that you want to talk through?
I got one for the room. I mean, you all are smarter than me. Are you bull or bear on the market? Call it from now until the end of the year. And are you more worried about inflation or deflation?
When you say the room, you mean me and Vic, or you mean the panel, the participants?
Neal, you started off. I'd love to
Well,
hear.
like I said, I'm not in the prediction business. I have no idea. I never would have thought the market would have rallied the way it did, and as the virus case load is increasing. What I do believe is that we're going to see increased heightened levels of volatility and chaotic trading, which is why we were able to make money in March, April, May, and June, which were very, very different types of markets, because we're in the business of capitalizing on structural inefficiencies. So the more volatility and the more chaotic trading there is, the better that's why we're on pace to do, we've already achieved essentially our year-to-date goals. I mean, we expect to obviously deliver more for the balance of the year. So I can't answer whether I think the market's going up or down, or inflation, deflation. What the hell do I know? I mean, if the smartest guys in the world who have been studying this for 100 years don't know, I certainly am not arrogant enough to think that I can predict that. But what I do think is that there's a heightened level of volatility and dislocation in the market, and we're going to be there to take advantage of it. So sorry, I'm not giving you the answer that you want, but I would encourage people not to try to predict those things, because I have found from personal experience that's a losing game.
Yeah, so I'll take the bait. I mean, I know that Neal is smarter, and probably it is a losing game, but
a lot of ways to skin the cat, my friend. I'm not necessarily smart. Just the way I do it.
My feeling is that the U.S. Fed has a lot of power, and that they are taking all actions that they can take to prop up this market. And so I think the financial markets are positive, at least through the election. So that's not exactly through the end of the year, but through the next several quarters. But I think it's going to be negative over the next 20 years, right? So I'm really worried about where China is sort of arranging financing and doing big infrastructure projects in Africa and building relationships around the globe. And so I think in the near term, the Fed is going to prop up the markets, already at historic levels and continuing, and that they can do that for a long time. If the US dollar stops being like the only reserve currency on the planet, then that's going to be really negative in a 10, 20, 30 year for the United States. And so I have concerns in the long term, but in the short term, I'm bullish. And I think obviously we're all biased to our sector. Health is really important. We see with COVID, so investing in health is kind of a fun place to be, because it's so personal and such a big issue. So, Brian, what's your prediction?
I mean, it's just kind of fun to do cocktail chatter about. I agree with Neal. I mean, who the hell knows? But I would say, the Fed has pretty much used all the arrows in their quiver. Negative rates would be one of the levers that they could pull. I know they've been on record saying they're not going to go there, but again, they don't have a ton of more, firepower. So I personally am predicting, sustained low rates, if not negative, for maybe some of the shorter duration stuff. I know we did touch negative on the 10-day in Q1, I think. So I think we're going to be in a sustained low rate environment. And in terms of where the market is, it's priced to go on a run. But I think the election and the COVID spiking, I could easily see a pullback there. I personally moved everything to cash, and I'm trying to figure out what to do with it. So maybe Neal will breach his minimum requirements, and I can participate in some of the cool stuff.
Well, we're not allowed to offer securities on here, but I think you can work with your financial advisor and assess your personal situation and find somewhere to put the cash, I'm sure.
Yeah, and I mean, I think honestly, energy and healthcare, I think, are the two most interesting plays right now. It's just in terms of, there's a lot of inefficiencies. There's I think you can probably create some alpha there. I think for real estate, another question we get a lot, I'm happy to give you my opinion on, is I think you need to wait till Q4, Q1, Q2 to see the deals. So, just hold on and be patient, because the Fitch ratings came out for June for CMBS defaults and delinquencies. And I think it's just kind of the beginning of what you'll see, especially in the hospitality and retail space.
Yeah.
Hey, Vic, I have a question for you. Obviously biotech, healthcare, it's a super hot space. There's a real possibility that we have a change of political party coming up. And I remember when it wasn't such a hot space, when everybody thought that the Democrats were going to win 2016. Should Biden win 2020, do you see that having an impact on healthcare and your space, the space that you traffic in?
Yeah, I mean, there's no question. So, I mean, no matter who wins, I think there's going to be massive change to the existing incumbents, right? So, I think that the hospital systems are in a lot of trouble, and so they're not all publicly traded. There's a variety of nonprofits and charity-based ones, along with some publicly traded ones. COVID is simultaneously bringing a lot of pressure on them and making them work a lot harder, and that's going to be problematic. If nothing changes in the administration, it'll be problematic. If there's any kind of renewal of universal coverage or anything like that, that will be a challenge, because they'll have more pressure on pricing. So they may get volume increases, but they'll get pricing. And so if Biden comes in, that will happen. If Trump stays in, there's a big push on transparency. Either way, the hospitals are being challenged. I think the insurance business is now a utility-like regulated industry. And so it's going to continue that way. Whether it is officially sort of servicing universal care or it is de facto utility is sort of immaterial for my mind. And then we're going to move to more keep people healthy, value-based care, wellness, early diagnostics, new treatment protocols. There's a bunch of new things that are coming up that I'm really focused on now that would sort of bring better health to people and generate returns by actually delivering more value versus sort of just patching up what's there. So that's probably an entire webinar, but that's my quick, there's going to be a ton of change. No matter who wins, there's a ton of change.
Yeah, should be interesting. Thank you for your insight.
Okay, well, we're a little over time. Thanks for doing this, Neal and Brian. Really enjoyed it.
Thank you.
We will we'll keep pushing forward. Appreciate it.
Nice to see you all. Thank you, Vic. Thank you
Thanks,
for
Vic.
organizing.
Have a nice
Brian,
weekend.
good to see you. Thank you, guys.
Bye.
Okay. Nice weekend.